Hey, Mark, how you doing today, buddy?
I'm good, Sam. How you doing?
Awesome, awesome. So you and I had lunch the other day, and we got on the topic of a couple of things, and you and I both thought, like, man, this is great information that needs to get out to people. So we're going to talk about a couple of things that are currently going on with this presidential administration. This has nothing to do with anything political.
No.
We are just talking about some things that may be coming in the real estate world based off the Trump administration. So the first thing, Trump has mentioned that he is potentially looking at a 50-year mortgage rate for people. So going from 30 to 50. So when you first heard that, what were your initial thoughts?
Well, a couple things, but let me just say I'm coming at this from a consumer perspective as well. I want to try to clear some of the fog out there because as some of these things are being said, Sam, you and I talked about it that everybody's an expert. Everybody starts chiming in. Now, I'm no expert, but I've been doing this for a minute. You know, I've been here in the Richmond real estate market my entire professional career. I was licensed in '89, dating myself a little bit, but I mean, it's a rare opportunity for me because I still feel like I'm 30 and I'm not, but I've got over 30 years of experience in this industry, so it's fun to have the energy and the knowledge at the same time. I feel like so many business people get so much knowledge, but by the time they've accumulated it all, unfortunately, they're either on an island or retired and having a great time, which is good, or they don't have that drive to share it and help other people. Anyway, enough of that. You didn't ask about that. Yeah, so we're talking about the 50-year mortgage. So I've heard the same stuff you've probably heard, which is all that's going to do is make the banks rich, and everybody's going to be buried in interest, and everybody blah 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 blah, and I guess for the rare oddball person that actually stays in their house for 50 years, and makes all 600 payments, that would be the case.
Which I wish we had the numbers on that. What's the amount of people that actually live in their home the entire time for that term or mortgage? Like me and my wife we've been married now 8 years, and we're on our second house.
Right. I mean, I actually looked that up. I used my professional grade ChatGPT account, and I said, you're an expert real estate analyst. You've analyzed all the data. What is the percentage of people? And I just did the 30-year mortgage, like the current available. I said, what is the percentage of people that actually stay in their house for 365 payments? 30-year mortgage, 360 payments.
Can I guess before you tell us?
Sure.
I'm going to say 25%. I feel it's going to be lower, but I feel that's a safe number.
It was so negligible, it couldn't compute.
Wow.
Serious.
So less than 1% of people actually stay in their home that long. Yeah.
And there's no real way to do it, to actually compute it, because it was telling me all the challenges. Well, what I surmised from the challenges is that's life. Yeah. Right? Because think about all the opportunities. Even if you stayed in your house for 360 payments, you're probably going to refi at some point. Yeah. You might do it to get other things in life. You might do it for a better interest rate.
Take out an HELOC.
100%. But the majority of people move. Yeah. Move. And it said the majority of right now, the median time people stay in a home right now is about 11 years, between 7 and 11 years.
Makes sense.
Yeah. So most people are going to move. Nobody's going to be there. Very little chance anyone's going to be there for 600 payments because most of them aren't there for 360 payments.
So really the term of the mortgage really doesn't matter for 99.9% of people.
It doesn't. And here's another, the one place it might catch up to somebody is if housing, if the pricing stalls. Yeah. Right. So somebody gets this new 50-year mortgage and they buy their house at a certain price and the market just stalls for a few years. And then they have a life event. And then they're going to try to go sell their house and get to the next house. Well, unfortunately, with the 50-year mortgage, the principal payout has been stretched out, as you know, it's all front-loaded interest, right?
Yeah.
So that front-loaded interest is going to drag out a little bit longer, which means you're not paying that principal down, which means you're building your equity shorter. So if that perfect storm happens, I'm in a market, the market has stalled, I bought a house, 3 years later I get married, we're having our first baby, we have got to move because it only has 2 bedrooms and we got to do something different. They can make a move. There will be. It's not like they're locked in because they have 100% mortgages available to people right now. They'll have them then. But is that the situation you want to get in? So that would be the only storm that, in my mind, that could happen. The benefits of a 50-year mortgage.
Well, hold on, let's pause right there for a second because you said like that's worst case scenario if it just stalls and things flatline. For the 8 years that me and my wife have been married and we've moved into 2 homes, my property value's done nothing but go up. Like in our first home was a townhome in Mechanicsville. We were in for about 4 years, and we bought it for $200,000, and it was worth close to the threes by the time we sold.
Nice.
And then our current house we paid $280,000 for, and our house is currently valued at like $415,000. So obviously there was a massive spike during the COVID piece, but the likelihood of somebody's property value just going like this is highly unlikely based on where things are now. Like I'm preparing, my kids are like 5 and 4. I'm already preparing for the fact that like they're not gonna be able to get their first home for $200,000. So I know in the next 18 years, property value is only going upwards from there.
Right. Yeah, great point. And in Richmond, we're actually a little more insulated than I'll say some other places.
Yeah.
Our market isn't really volatile like some of the Florida markets, the Vegas market, Las Vegas market.
This is one of the hottest, like we're in the top 10 cities of like hottest real estate
That just
markets.
came out, didn't it?
Yep.
I mean, that's pretty wild. As long as we don't do anything statewide that messes all that up.
Yep.
And the real driver behind that is Virginia is really good about being fair to businesses. So when businesses come in and jobs come in and employment's good, your housing market's good, your grocery market's good, your restaurants are thriving, you and I are in business, everything's better. When you start trying to overtax business or lean into business, and business is mean and business is evil, and business leaves, you problems.
Yeah.
I mean, all across the board. You and I know that, right?
Yep. And we got some great things happening in the area with the casino being built down in Petersburg. Everybody's not going to be living in Petersburg. Not everybody wants to live in Petersburg. So, like, those people that are going to be higher up, executives and GMs of that casino, they're probably going to want to live in Richmond area. And when you got these people moving from, like, New York and Miami and all these towns where they're used to spending way more money on their living costs, when they come here, they're like, man, this is dirt cheap. Like, you guys are only asking $500,000 for that? I'll pay you $6 million.
Right. And then think about all the jobs that's going to create. And then think about those people need to buy groceries and they're going to go to restaurants and they need clothes and they need things. So it's just going to lift that whole area up, I mean, and that's the story for any business, right? Any business that comes in and can create jobs like that is a good thing. So back to the 50-year mortgage, if we look at it as a whole, the biggest benefit from the 50-year mortgage is, let's just take the average house, $350,000, $400,000, and you're going to look at a 30-year and a 50-year at today's current interest rates, which they're right around 6% or ish. You're probably going to save a couple $100 a month, maybe $250, $260, maybe $275, something like that.
Yeah.
But for some people, that's I'm in a house or I'm not in a house.
Yeah.
For some people, that $200 is now a kid's school tuition. It's a savings plan.
Yep.
$200 a month is good
like
money.
$400 a year that you're saving.
Right, and you do 3 years, and you do 4 years, and I mean that's nothing to sneeze at. And if it means getting in a house and not getting in a house, and then my dad always told me, he said, when I bought my first house, and my dad was a real estate broker and a custom home builder, so I kind of been in it my whole life.
Yep.
He said, son, it's really hard to get on the merry-go-round, but man, once you're on, it's a good ride.
Yep.
And he was talking about getting into home ownership.
Yep.
And you and I talked about that.
Absolutely.
Back to what you were saying earlier, that if you can get into a house and you can afford a house and you didn't overstretch yourself, which a lot of the banks won't let you do because of the ratios and stuff they do.
Yeah.
And a lot
after that big 2008 crash, banks don't play that game anymore.
Exactly. And a lot of people that we work with at Napier, they're not even buying at their max. They're like, okay, the bank said we can buy this, but we're going to buy here.
That means you have very smart clients.
Exactly. Well, and it's up to us to provide them great coaching, so they can make a great decision.
Yep.
I mean, it's all about helping your client make the best decision for them.
And you also have the option to pay quicker. Even if this was a 50-year mortgage, you can eat up some of that principal. So the years you get a bonus from your job, or like you were just getting in knowing this was a comfortable price point, but it's like, hey, every other month we can make an additional mortgage payment or throw another $500 on that.
Yep.
You can still get yourself in a good spot financially, so that as the value of your property increases, you're not underwater on that home.
That's another great point, Sam. You just triggered something else in my mind. If you can qualify for a 15-year mortgage, because if you think about it, the 15-year payment's going to be higher, right? The interest rate drops a little bit, so that the pain of that higher payment isn't truly double, what your 30-year payment is. You still might want to get a 30.
Yeah.
And here's why.
Just give you some breathing room.
That's right. So that month that the HVAC goes out, or the month that we got a car blew up, or hopefully not exploded, but you know what I'm talking about. It doesn't work anymore, and you got to get a new car. You can drop back and make a couple of those 30-year payments, which are going to be substantially less than a 15-year payment.
Yep.
And then you have the choice to jump back in and pay that principal down quicker.
Absolutely.
So get your 30, pay it off extra as much as you can, but you don't have to.
Yeah.
So that's some advice we give people as well in the term of the mortgage.
And it's also like planning ahead, like knowing if you have a great realtor like the ones at Napier ERA where they're coaching you in this. Because I remember our first property that we bought, and talking with our realtor, we knew that the property value was going to continue to increase in this area. One thing I always look for when I'm looking at a neighborhood is how close is a bank. And I'm like, if a bank establishes a presence in that area, property values are probably going to continue to go up. And you're looking at things like grocery stores being put up, or there are shopping centers, like all these different activities.
Right.
So if you plan it out and you're looking at that and you're like, hold up, I can get in this neighborhood for this price if I do a 50-year mortgage, knowing that this is going to be one of the hottest areas in the next 5 years.
Right. Absolutely. And like we were just talking about with the 15 and the 30, or maybe you can look at the 30 and the 50, and you can go to the 50 and you can make extra payments on that.
Yep.
And knock that thing down.
Yep.
So, kind of circling back to where we started, I don't think there's very few people that are going to stay in there 50 years. There's very few people that are going to make banks rich by making 600 payments in the same daggone house. Life is going to happen. They're going to move. They're going to refi. They're going to do something else. And when they move, they're going to pay off the 50 and go get something else. And maybe they've got the equity now to go to a 30 or a 15.
Absolutely.
I got a stat for you that will blow your mind. How many people, what percentage of people in the United States live in a home and don't owe a penny?
Ha!
Right?
That's 1% probably.
40.
Whoa!
It is just under, I looked it up this morning, just under 40% of people, crazy, live in a home with no mortgage.
See, that's all the
that's
all the boomers who got their homes for like 30 grand.
There's quite a few of them out there.
They're like 2 million.
Yeah. And like you just said.
Well, that number has to skew a little older, because now what's the average age for a first-time home buyer is getting like to 40.
40.
So it's like, those are the people that were in, because my parents, I think, bought their first home when they were in their 20s.
Right.
Like early 20s.
Right.
And now life is just happening a lot later for most people. A lot of people aren't having kids till they're in their 30s. Like, my parents were popping out babies at 21, 22, 23 years old. Like, those things just aren't happening anymore.
Right. Now, I'm not as old as your parents, I don't think.
No. Yeah.
But I was in the generation that kind of thought the same way. Mm-hmm. And there's some big differences there. I mean, I bet the first house your parents bought, and I know the first house I bought was not HGTV.
Yeah, no.
It was not sexy, move-in ready.
It's called a starter home for a reason.
I mean, the one I moved in was 2 beds, 1 bath, shag carpet, smelled like you know what. And I tore the carpet out myself. And I washed the floors with Murphy's oil myself. I let the floors dry out. I put a coat of wax on the floors myself. Mm-hmm. I saved a little money and had a tiny kitchen redone in it.
Yep.
And that's different.
Yeah.
I mean, now we've kind of, I feel like some of the buyers have set themselves up with expectations that push them to 40 years old, second or third career, job promotions, two incomes flowing in just to get what they want.
When you get a house hack and like get a duplex and rent the other side out, like have somebody else paying off the mortgage. Like there are so many different tools that people can use, because I think in my latest research, for a majority of Americans, this is their number one way of creating wealth.
100%.
Most Americans can't sniff out retirement, things like that, if they are not homeowners.
Generational wealth, number one, owning a house.
Mm-hmm.
Has been, I think, always will be.
Yeah.
Unless we really screw it up somehow.
Yeah. That could happen, but I don't see it happening.
Yeah.
And isn't it a thing where, like, I think America is one of the only countries where we've been limited to 30-year mortgages. Don't overseas, like in Europe, I thought I read something before. You may not have seen this, but I think 50-year mortgages are a normal thing, like in Europe and Asia.
There are
places.
Well, here's the funny thing. It's either one way or the exact opposite. Some countries don't even have mortgages at all.
You got to pay that whole
right?
thing up front.
And then other ones have, staggered mortgages that go up as high as 50 or 60 years in other countries. So we're not the only ones that would be doing this. We're not the trailblazers and the only ones in the world that are this crazy. Because you're right, it's been done elsewhere.
Yeah, it's been modeled other places.
Yeah.
And then I know this is going into another tangent, but I want to get to our second topic.
Okay.
But house hacking, like a lot of communities, like Hispanic families, they'll move everybody in to afford their first home. It may be a 3-bedroom home with 8 people living there, but they make those adjustments, those improvements that you were talking about that you did with your first property. They grow some equity in there. They help the next person in the house go purchase a home. Then half the family stays at this one, the other half goes to that one. They build that up, build equity, and it's just a generational thing. Like a lot of people just don't understand how you can utilize home ownership to create wealth. Like
imagine that family that the families you were just talking about. Let's say it's a 4-bedroom home and 4 families move into it.
Yeah.
I'm not going to talk about the whole multifamily zoning and all that,
Yeah.
But think about that. If it's a $2,000 mortgage-ish, you got 4 families in there. Each family's paying $500, but both parents are working. All the kids are getting along. And doing, how much money are they saving so they can launch into their house?
Yep.
I had one client one time. He was moving his whole family from California, himself and then his grown kids, and they were coming one at a time. And he calls me up out of the blue as a referral from one of my current clients. And he said, hey, Mark, he tells me his plan. Here's what we're going to do. So I'm thinking we need a bounce house. I was like, I'm in real estate, man. I don't do those kid. We don't do kids parties and all that. He goes, no. My bounce house is going to be a house we're going to buy. And then our family's coming over one at a time. They're going to live in that house, learn the area for a little bit, and then go buy a house. And then the next member comes in and go buy a house. And then the next member comes. And maybe the last one that comes in, or whoever, if they like it, when they get in it, they can keep it and we'll go buy something else.
Yep. The problem with most people not doing that is most Americans, I'll say, aren't comfortable being uncomfortable for short periods of time.
Great point.
Yeah. Like you don't, and my wife had to put me in check when we bought our first house.
They're good for that.
Yeah. Because I'm thinking like, oh man, we're ready to buy a house. Like I need to pool in the back. Like da 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 da. No.
That's
we're
not
not
how
at
it
that
starts.
level. We don't want to be house poor. Like this is a starter home. Let's get something that's going to be comfortable for us, and we can grow into that. Let's get a quick snippet. So we just talked a lot about that 50-year mortgage.
Yeah.
In 30 seconds, give me your opinion. Do you think this is something that's going to happen, and do you think this is a benefit or a pro or a con for most people?
I think the 50-year mortgage should happen. I hope it does happen, and I'm banking on it's going to happen.
Beautiful.
I think that's going to be the deal, and I think it's going to help the people that have good counseling and when to use it and when not to use it. Get over that $10, $50 difference so you can get into your first house, get your generational wealth going, and then, as my dad said, ride that merry-go-round, have a good time, and just keep going with your housing.
Boom. That's TikTok right there. All right. Now, the second topic we want to hit on, the Trump administration has also discussed the transfer of your mortgage rate to your next property.
Ooh, buddy.
I'm really excited to talk to you about this one because Me and my wife have a 3.2% interest rate on our current home.
Beautiful.
And you said the standard average rate right now is in the sixes.
Right around
Some
6.
people are getting high 5s. We may see mid 5s again, maybe.
Maybe later in the year.
Yeah, but probably living in the 6s. That's double what I'm currently paying.
Right.
So if I can get my next home, let's say it's going to cost me $700,000-$800,000, but I can get it at an interest rate that's half that. What is that going to do to the real estate market? Is that going to be a positive effect, ripple effect, or is that going to be something that cripples things in the real estate market?
It's going to be incredibly positive. And if we had to prioritize these two things, I would put there, I think the nickname is the portable mortgage.
Yeah.
I would put the portable mortgage, and if the president calls me, I'll be happy to talk to him about this and get him straight.
Make the call, man.
I got him on speed dial.
Yeah, that's two presidents. We got the president of the APRA, president of the United States.
I would tell him to please prioritize the portable mortgage. And it's funny, I was talking about this a couple of years ago when all the talking heads started talking about the lock-in factor, and the lock-in factor is what you and I are experiencing right now. You're at 3.2. I think I jumped in a little after you at like 2.8 or 2.9. I know, man. It's crazy.
It's
crazy.
free money.
It's crazy. And
we don't want to move.
Why would I?
Yeah.
I mean, and I'm in the business.
Yeah.
I mean, I can make this as cheap as possible on myself using all my tricks, which I teach all my clients, and all of our Napier associates teach. But it's stalled me.
Yeah.
And I'm like, why would I? Because practically, if I'm moving right now, okay, I'm in a house. Let's just say that my house is $400,000, and I want to go to a house that's $600,000, and it's probably the same size house. It's just newer, or different, or whatever. So I'm not really getting a whole lot more. But if I'm going from my house at 400, which I have at 2.8, and let's say my payment's $1,250. I mean, that's reality.
Yeah.
Some of us are sitting on payments under $2,000 in a full house for our families, right? Right? But we look to make that move, and we're going to be at $2,900. We're going to be at $3,150. And it's like, oh man, I'm going to double my housing expense. Yeah. That's a cash flow difference.
Yeah, big time.
And people pay attention.
That's when people have to make decisions like, guess we're not taking that vacation this year, or guess little Timmy's not going to go to camp this year.
I'll take you to work. We'll sell one car. We'll have one car instead of 3 cars, 2 cars, whatever it is. It's life-changing stuff.
Yeah.
So imagine, so you're in your house, and you got your 3.2, and you've been making your payments, and your mortgage, your mortgage principal is coming down a little bit. As you said, the COVID years just spurred some crazy. I mean, like some houses are 50% equity growth.
Yeah. So
you jump in at 400. Now you got $200,000 in equity sitting there. Let's say you've paid your mortgage down to 3. If you've been there 4 years, you paid your mortgage down from 4. So you probably got a 10%, 40,000. So you started at 360, and let's say you pay it down 300 even.
That was like watching Rain Man right now.
Oh, I can do some of it pretty good. So you got 200,000 in equity. We just said now you've only got a $300,000 mortgage on a $400,000 house, but now your $400,000 house, 3-4 years later, right, is probably worth maybe up to 6.
Yeah.
Typically people move up about 150% of what they're in. So now let's say your $400,000 house is $575.
Yeah.
Let's say you sell it for $550. You only have a mortgage of $300. So $300 to $550 is $250,000. Now, here's where it gets sexy. You get to take that $300,000 mortgage at 3.2% to the next house. So you buy that next house at $600.
Yeah.
How much equity? I mean, how much total money did we say you had? The $300 plus the $250?
Yeah.
$550,000 is coming your way, with only $300,000 of it, with that $1,200 a month payment, is going to buy that $600,000 house.
Yeah.
You got to finance $50,000, or you have hopefully saved $50,000 in the 4 or 5 years you've been there. Let's say you only saved $25,000.
Yeah.
So you need to finance $25,000 more. Well, you can probably get a second mortgage for $25,000, and then your focus is to get that sucker paid off as fast as possible.
Oh yeah. And the banks are drooling at you. They're looking at you as the ideal client.
And you're in that $600,000 house for $1,250 a month. Your previous payment plus the $50,000 loan you got, if you got one, which might add a couple $100 to it.
Yeah.
But you are nowhere near $3,150.
So what does that do? So on the flip side of that, does that change anything for the people that are just now entering the market? Like, that's great for the ones of us that locked in those interest rates in the 2s and 3s. But if I'm moving to a more upgraded home, it's more expensive. But personally, it's not costing me much more because of my interest rate and the equity I got in the home. And I'm selling my home that I purchased for whatever, $300,000, $400,000, so it's $150,000 more. Is this hurting the buyer market? Because the big issue right now is supply and demand. We have a lot more people that need to buy homes, but less availability because nobody's moving because they're at a 3% interest rate. How is that going to shift things for the market?
You just talked yourself into your own answer. What did you just do? You just moved. So what did you make available?
Another home.
The house that you were in. And a house that you were in that was one of your first homes. So for the next person, it's probably going to be one of their first homes.
Yep.
So what we're doing now is we're opening back up the first-time home buyer market with some inventory. And when you start opening up the first-time home buyer market with inventory, well, what does that do for buyers? Well, buyers have just gone through, during the COVID years, buyers have just gone through a time where negotiations were insane.
Oh, it was crazy.
Competing against 10, 12 offers, man. You gotta take all of your protections off the table, contingencies off the table. What do I mean by that? You're pulling off home inspections. You're getting grandma to help you with the loan to get your loan down as low as possible. Or grandma's gonna show up with her investment account. She's gonna buy the house for you. Then you're gonna get it financed and you're gonna pay grandma back.
Yep.
That's the kind of stuff that was happening just to get into houses. If we can get the portable mortgage going and you and I start freeing up these homes for first-time home buyers, second-time home buyers, more inventory, that means more fair negotiations. Don't cry, sellers. I mean, if you're a seller and you wanted the 12 offers and you wanted $200,000 over asking price, you already missed it.
Yeah.
It was gone 2 years ago, right? There's some pockets in some markets that are still getting that.
But that's not the norm anymore.
It's becoming less and less the norm.
Yeah.
Unless you have to be in a certain neighborhood that's super hot, you do not have to do that as a buyer. And you need somebody that can tell you where those pockets are.
Yeah.
And where they're not.
That's going to create a frenzy, though. I can just see, first off, if I can move into a bigger house, nicer home, and the exact neighborhood I want to be, and I'm paying the exact same mortgage rate, if not less than I was before, sign me up. Let's go. Like now, let's go start looking for homes. Like,
right.
That's going to create a frenzy.
Yeah. It could create, it's probably going to create a frenzy for the second home, third home, fourth home market.
Yeah.
Which typically are a little bit slower and a little less competitive than the first-time home buyer market, right? So hopefully the counties and the cities and the planning commissions and the board of supervisors will help us out.
Yeah.
We are at a scary shortage of building permits. We've got to get these boards of supervisors and these counties to help builders, help developers develop things in a way that's inside the county plan, within the county comprehensive plan, and build in a smart way. Because holding back permits, turning down neighborhoods does not do anyone any good.
Yeah.
If you're going to turn them down, let's say if you do this, this, and this, you're in. Let's figure out how we can keep housing going. Yeah. It's not the evil ogre. Yeah. You know, the builders don't make a killing on every house. Yeah. They make some money to go in order to stay in business for the next house.
Those profit margins aren't as big as people think.
They're not at all. And being a builder's son, I saw them from the backside. So I know exactly what I'm talking about. Ignoring housing and saying it's evil, it's an ogre, NIMBY. Yeah. Don't put that, not in my backyard. When you move out to a rural area because you like the rural area and you moved into a neighborhood in the rural area, and you don't want a neighborhood like yours being built down the street because it's messing up the rural feel of the area. Yeah. If you applied that rule to yourself 3 years ago, you wouldn't be out there.
Yep, exactly.
Right? So let's do it. Let's agree to do it smart. Yeah. So this whole portable mortgage thing is a game. It could be a really nice game changer. Yeah. and it could get a lot of people that are forced into renting right now into a home, because there are a ton of people. I mean, there was this philosophy going around, years and years ago that, millennials don't want to buy a house. They want to stay mobile. They don't want to be in a home. They don't want to.
I remember that.
Remember
Tiny
that?
homes and we just want to travel and da-da-da. Yeah.
Yeah, you can do both. And then some genius had the idea of, instead of speaking for them, let's go ask them.
Yeah. That's pretty smart.
Overwhelmingly, millennials said, oh, yeah, we see ourselves in the house.
Yeah.
It might not be at 22 years old,
Yeah.
but they definitely see themselves in buying a home. Yeah, so
what's the likelihood? This all sounds phenomenal. From your perspective and the research that you've done and being in the industry for so long, what do you think the likelihood is of a transferable mortgage?
I'm going to give it right now today, at the beginning of 2026, I'm going to give it 60-40.
Okay.
That's going to happen. And the reason I say that is because finally, not just in Richmond, not just in Virginia, North Carolina, South Carolina, New York, New Jersey, housing's on the big dance floor.
Yeah.
Everybody that's anybody realizes we got to do something about housing. I heard a phrase this morning and I love it. Choices have invoices. I mean, right?
Jeez.
Choices have invoices.
Oh, that's a good choices.
Have invoices.
Have invoices. I'm putting that on a T-shirt, man. That's
Same.
A bar.
Same. I should have trademarked that before I said it. Actually, it's not mine, so I can't. My buddy Jared James said that this morning in one of his talks, and he was talking about exactly what we're talking about.
Yeah.
When we make choices and the interest rates are so low, which allows us to expand our vision. So now I'm a first-time home buyer in my first job. I can get a $400,000 house, which 3 or 4 years ago was a second home, not a first home.
Yeah.
3 or 4 years ago, you got a $400,000 house in our area, in certain pockets in our area. Man, you were in 4 beds, 2.5 baths, 1 car, 2 car garage, had a backyard, fence, everything. And
crazy how that changed, because when we're growing up, like you'd see like Family Matters or Full House or something.
Yeah.
Like that home, like for Full House in San Francisco, that's like a $15 million home.
right, back then it wasn't.
Yeah,
but now it is.
Yeah.
And it's like, okay, wait a minute now. So we have all this appreciation, and now we got 6% interest rates. Choices have invoices.
Yeah.
We're sitting in that invoice. We got handed the invoice a couple of years ago when the interest rates just went through the roof within 6 months.
Yeah.
That was our invoice.
Yeah.
So now we got to make some choices to reduce the invoices. And I think these choices, it's going to have to be that big.
Yeah.
The Henrico County throwing $8 million at a townhouse subdivision is great. It wasn't 8. I think it was more like 4. That's good stuff. That helps.
Yeah.
That is a Band-Aid on a cut artery in your femur.
Yep.
It needs to be bigger things, and it needs to be more nationwide. So I am glad we're on the big dance floor.
Yeah.
I'm glad housing is like, wait a minute, we can do a couple things here that aren't going to be a revisit of 2008. They're not going to be a financial catastrophe. One person said, "Oh, Mark, if we do that portable mortgage, why would a bank do that? Because then they don't get that mortgage paid off, and this, that, and the other." And I'm like, well, the reason the bank's going to do that is because
2 out of that.
they get a brand new mortgage, a full mortgage on the house that we just sold and moved to the next one, right? At today's interest rates.
Yep.
And somebody's going to pick up the gap money, the $50,000, $25,000, $100,000 gap money on a smaller loan.
Yep.
So the banks will be just fine.
Yeah.
If the portal mortgage goes through, I think the banks are going to be just fine. And the way I described it to my wife a couple of years ago, when the thought hit me, I was like, what if we could just change addresses on our mortgage? Wouldn't that be cool? And she goes, what are you talking about? And I explained the whole thing to her. 2 years later, here we are.
Yep.
It's on the big dance floor. And she's like, golly, this would be really cool. This is what you were talking about 2 years ago. I was like, yeah, it is.
Yeah. A lot of people are going to be moving to their retirement home. Like, hey, it's fine. We can finally get to the beach now. We can finally live on the water. Like, it's going to change some things. Yep. Is there a possibility, and we didn't discuss this at lunch, but it just hit me as we're sitting here talking, is there a possibility of a combination of both these things happening, a 50-year mortgage and the transfer of interest rate, or is it one or the other?
I think there's a possibility they both could happen because they're both happening at the basically at the federal level.
Yeah.
You know, with Freddie Mac and Fannie Mae that back mortgages and then kind of run the whole backside of mortgage qualification and the mortgage setup.
Yeah.
It's a possibility they'll both happen again if they prioritize it.
Yeah.
I hope they do the portable first and then roll out the 50, even though I think, and I'm not a banker. Yeah, I mean, you've got banker friends, and they've probably been on your podcast before. They can speak to this a lot better than I can. But just as a dummy on the outside, from the purchase and sales side, I think the 50-year mortgage is going to be easier to implement and turn the switch on. So that might get popped first.
Yeah.
And then the portable mortgages go. There's going to be some more details behind that.
Yeah.
You got to have some big brains figure that out so that does not get abused and turn into a 2008 scenario.
Yeah.
You know.
Whew. Can you imagine if both those things happen? But that's a jolt to an industry.
Yeah.
Like, that's like Terminator 2, like, coming back. Like, yeah.
As bad as the interest rate skyrocketing, like it did a few years ago.
Which these interest rates aren't bad. Like, my parents, their interest rate was probably like 18% or something like that.
Skyrocketing. They went from they went from 2 3/4, maybe a bottom of 2.5, up to 8+.
Yeah.
That's bad.
Yeah.
But it never hit 10. When I got in the market, it was 10.
Yeah.
Some of our parents were in the 14, 17% range. My dad was selling starter homes in his neighborhoods back when it was 17%.
Whew.
People made choices.
Yeah.
And they got
Those
into
choices have invoices.
and they got into homes. They paid their invoices.
My kids are gonna be walking around saying that. Some kid's gonna like come up to them in school and threaten to punch them. My daughter's gonna be like, "All right, think now. Choices have invoices."
That's a great use of it
You
too.
can hit me if you want to, but that's gonna be an invoice coming your way.
That's right. You're not going to pay the invoice.
That's it.
Oh, I love it, man.
So to wrap this up,
Yeah.
real quick in like 60 seconds, give everybody a quick summary between the 50-year mortgage and the portable mortgage.
I think the 50-year mortgage is a good idea. I think very few people are ever going to stay in the house for 50 years. It gives them a couple $100 to a $300 to a $400 reduction in monthly payment, which can put people in houses that right now today can't get into a house, and they want to be in a house. They want to raise their family in a home. That's going to open opportunity. And I think the downside of that everybody's kind of preaching about making banks rich and this, that, and the other, and too much interest, and you're not paying your principal. I think the downside of that's very small.
Yeah.
In all honesty. People need to be smart about it. Realtors need to counsel their people through it. I know bankers are going to counsel people through it, and so they can make good decisions. The portable mortgage, I think, is a really cool opportunity at a game change. I think for a lot of people, like you were talking about, a lot of people that were able to take advantage of that probably are getting to the point of we need our next home or the retirement place even, right? And I've got the equity in the house and this, that, and the other. I could take my portable mortgage. I could downsize, take just what I have as my portable mortgage, put that into a new property entirely, not have to worry about the gap. I can downsize and retire with my really low mortgage payment and only 10, 12 years to pay it off. So I think the summary of those two, both are good things if they're done right and legislation is done wisely with business people that are in the mortgage game and that are in the housing game. The downsides are very small and the upside is huge.
Love it. Love it. So, Mark, thanks for having this conversation. This is information that people really need to know. There's a lot of misinformation spreading around on social and the internet, so cleaning this up is big time. And if you're in the Richmond, Virginia area, I mean, why would you go anywhere else? Napier obviously has the knowledge. They know what they're talking about. They're well-trained. They stay up to date on all these things. So keep in mind as you guys make those changes and you're upgrading, you're downsizing, whatever the case is, you definitely want to consider Napier ERA as the brokerage that you work with. But we'll see how this plays out this year. You got me hyped, man. I'm hoping we get one or the two or both.
Hopefully we come back and do this at the end of the year. We can talk about the benefits and all the good things that are happening. Sam, thank you for your time.
Yep.
Thank you for the compliments. I appreciate you always, man.
Absolutely. Appreciate you. We'll see you guys soon.
See ya.